Hello, everybody. My name is Elton GUBERAJ, and I am a lecturer at the Agricultural University of Tirana. I'm going to present an article with the co-author Aurora HOXHA named Profitability Analysis of the Albanian Banking Sector. So let's begin with an introduction. The Albanian banking system has undergone an extraordinary transformation after the political and economic changes that took place in the early 90s. The development and reform of the banking system, especially in transition economies, plays a crucial role in economic development. With this study, we aim to create an historical summary regarding the performance of the banking sector in Albania over the years, to analyze all performance indicators of the Albanian banking system, to investigate and present the profitability determinants of the Albanian banking sector, to demonstrate the close link between banking sector efficiency, monetary policy, and macroeconomic elements that assist commercial banks in defining strategies for achieving their final objectives. We have made some research questions. What are the main determinants of the bank profitability? To what extent do these determinants affect bank profitability? How is the efficiency situation of the Albanian banking sector? What are the implications for banking management? And last, what are the further improvements that should be suggested for the banking sector based on the discussions on the study findings? Let's talk about some literature review. The study is based on secondary quantitative data, which are taken from banks' financial statements and public data of the Banking Association and Central Bank. Various researchers state that the advantage of using secondary data includes a higher quality data compared to primary data collected by the researchers themselves, and a data source that is permanent, more open to public scrutiny, and available in a form that can be relatively easily controlled by others. The existing literature presented is categorized according to the places where the studies were conducted. So, internal factors include specific factors of each bank, such as the elements that are reported in the financial statements of a bank. In contrast, external factors refer to industry-specific indicators, as well as macroeconomic and legal factors of the environment in which the bank operates. The most commonly used internal variables are liquidity measure, credit risk, bank size, and capital adequacy, while external factors include long-term interest rates, inflation rate, value of gross domestic product, as well as industry-specific variables such as ownership structure, measures of concentration within the industry and within the market, and size of the industry. Moreover, among the most typical indicators used to express banking profitability are return on assets and return on equity. This study will assess the determinants of profitability of the banking sector in Albania for the period 2010-2020. The annual data for this purpose are obtained from the Bank of Albania, the Albanian Banking Association, and from the websites of individual banks. The financial statements will be withdrawn from the financial statements of commercial banks during the aforementioned period. Data related to macroeconomic variables are obtained from the Bank of Albania. So this study will employ 6 variables. These include dependent variables, which are return on assets and return on equity, and the independent variables, which are the logarithm of total assets, the capital ratio on assets, credit ratio on assets, and the last one, provision ratio to total loans. The hypotheses raised for this study are as follows. Total assets will have a positive impact on profitability. The growing capital of shareholders has a positive impact on profitability. High credit risk will have a negative impact on the profitability of commercial banks. High bank liquidity has a positive impact on profitability. There is a positive correlation between inflation and bank profitability. And the last one, long-term interest rates, which include inflation expectations, have a positive impact on profitability. Let's talk about the dependent variables. The two most widely used determinants of a bank's profitability are the ratio return on assets and return on equity. ROA is calculated as the ratio of pre-tax income to total assets. A disadvantage in using ROA as a measure of profitability is that it does not take into account of balance sheet data, though causing positive bias towards the bank's valuation. Return on equity instead indicates the return to shareholders for each unit of monetary capital they have invested. So ROE is calculated as the ratio of pre-tax income to total capital. The main disadvantage of ROE is that this ratio will be higher for banks with lower capital levels. These banks will be associated with a higher level of risk due to the higher level of leverage. In addition, in many countries, the degree of capitalization is established by the monetary authorities. For these reasons, the literature refers to ROA as the most appropriate measure of benefit for the banks. The explanatory variables and their expectations. Explanatory variables that have been used can be divided into two categories. The first one, specific for each bank, the internal factors that are related to the characteristics of each bank, such as bank size, capital ratio, liquidity, and credit risk ratio. And the second ones that are the external factors that are related to the macroeconomic environment in which banks operate, such as long-term interest rates and inflation. More specifically, the explanatory variables and their expected effects, according to the existing theory and literature, are analyzed as follows. Bank size, the total assets consisting of the current assets and long-term assets of an entity. For banks, the most important assets are loans, because through loans, banks generate the highest percentage of their income. In the analyzed literature, the value of total assets determines the size of a bank. For analytical purposes, we use the logarithm of total assets since all the other variables are in ratios. It is expected that total assets will be a positive impact on profitability. However, other researches suggest that if the size of the bank increases too much, the size effect will be negative since very little expense can be reduced by increasing the size of a bank beyond a certain point. The second explanatory variable is capital to assets ratio. It is used as a variable of capital. We accept the positive impact of capital on profitability. The positive impact may be due to the fact that capital refers to the amount of its own funds that the bank could use to support its activities, and therefore capital provides collateral in the event of adverse conditions. The third explanatory variable is credit risk. According to some researchers, the provision ratio to total loans will serve as an indicator of credit risk. According to the theory, high credit risk will have a negative impact on the bank profitability. This can be further explained by the fact that high accumulation of outstanding loans will bring low income for a bank. Banks, therefore, can improve profitability by using improved credit risk review and monitoring methods. The fourth variable is the liquidity ratio. Assets loans ratio measure the liquidity of bank assets related to bank loans. The higher this ratio, the lower the liquidity for a bank. Since interest on loans are the main source of income for a bank, we accept a positive ratio in the liquidity variable, so as more loans show more income. The fifth one is the inflation rate. It is one of the variables widely used to capture the effects of the macroeconomic environment. Most studies have found a positive correlation between inflation and bank profitability. Some researchers explain the outcome will depend on whether inflation is projected or unpredictable, or whether banks' wages and other operating expenses grow at a faster rate than inflation or not. Projected inflation means that the bank will have adjusted interest rates in order to increase their income faster than their costs, and though earn higher profits. The opposite results will come if the inflation comes suddenly. And the last one is long-term interest rates, which include inflation-related expectations that are exceeded to have the same impact as inflation. Both macroeconomic factors will be highly dependent on the maturity of the economy being analyzed so that inflation can be accurately predicted. Now, let's talk about the empirical analysis. To test the relationship between banking profitability and specific banking variables and those of the macroeconomic environment, we have modeled the following form of the linear progression model that is shown in the two formulas in this slide. So this section presents the results achieved by the regression analysis. Using the equation and variables we explained earlier, and the models we will examine are as follows. The two models are shown in this slide and show the relation between the dependent and the independent variables, ROA, and the relationship with its independent variables. And the second model shows ROA with the independent variables. All the results are shown in this table, and we have made 6 equations showing ROA and ROA and the relationship with the independent variables. So we have made some we've got some findings and interpretations. Based on the results presented above, the coefficient of the size variable is positive and statistically significant in 5 of the evaluated equations, in equations 1, 2, 3, 5, and 6, implying that bank size and profitability have positive relationships. In addition, the coefficients for the variable size do not change significantly when the benefit measure is ROA. Example, equations 1, 3, and 5. And when this measure is represented by ROA, equation 2 and 6. This result is a testament to economies of scale. This result is expected to weaken further in the future because over time banks will not have the same opportunities to exploit economies of scale. The credit risk variable coefficient is significantly negative in the 5 equations 1, 2, 3, 4, and 6. The liquidity ratio coefficient appears to be positive and statistically significant in the 4 estimated equations, equation 1, 2, 3, and 4. Furthermore, empirical analysis shows that inflation is negatively related to the bank profitability. Finally, as expected, the analysis reports a negative interest rate coefficient. However, the interest rate coefficient seems to be significant only in equation 3. And that's all. Thank you. If you have any question, you can contact us at our email.